All right, something massive just happened in silver. And if you blinked, you probably missed it. In less than a week, silver went from a blow-off high at $121.64 to trading around $81.82 as markets opened Monday. That's more than a 30% wipeout in days. And here's what should get your attention. The intraday flush briefly kissed the low 70s. We're talking about a violent mechanical sell-off that caught almost everyone off guard. Now, here's the urgent part. This wasn't just panic selling or vibes turning sour. The real trigger hit quietly over the weekend. The CME raised silver margin requirements by roughly 36% right before global markets reopened. Both exchange notices and brokerage alerts confirmed it almost simultaneously. Stay with me because I'm going to show you why that timing matters, how this kind of move creates forced selling, and most importantly, how you can spot these setups before they hit next time. If you're holding silver, if you're watching this market, if you're trying to understand what just happened, your job right now is to understand the mechanics, not the emotion. And if you're watching this right now, you're already ahead of 90% of people who are still just asking what happened. Before I explain what actually caused this move, let me teach you something most people don't really internalize about leveraged markets. When you trade futures, you're not buying silver the way you buy a physical coin or a bar, you're renting exposure. You post margin, which is basically a good faith deposit, and the exchange decides how much that deposit needs to be. Think of it like driving a car with a rental agreement. If the rental company suddenly says, by the way, you need 36% more security deposit today or you lose the car. It doesn't matter how much you love the car. It doesn't matter where you think you're going with it. You either come up with the cash immediately or the keys are gone. That's what margin hikes do. They don't care about your fundamentals. They don't care about your narratives or your long-term conviction. They force action right now. Now, most people understand margin on some basic level. They know it's leverage. They know it lets you control more exposure with less capital. But here's what they miss. Margin isn't static. It's a risk management tool that the exchange adjusts based on volatility, price action, and systemic stress. When markets get choppy, when price moves get extreme, when risk models start flashing red, the exchange can raise margin requirements to protect itself. And when that happens, everyone playing the leveraged game has to adjust instantly. There's no grace period. There's no negotiation. You either post more collateral or you're out. So what does that tell us? It tells us that in leveraged markets, your position isn't just subject to price risk. It's also subject to liquidity risk and structural risk. You can be right about direction, right about timing, and still get wiped out if you don't have enough cash to meet a margin call. That's the hidden danger most retail traders don't see coming. They think the only way to lose is if price goes against them. But in futures, you can lose, even when you're right if the exchange changes the rules mid-game. And that's exactly what happened here. If this is making sense so far, drop a comment below and let me know. I want to hear what you're thinking about this move, whether you were in the trade, whether you saw it coming, or whether this is completely new information for you. Your engagement helps me know what to cover next. Now, here's what's actually happening under the hood. The primary driver here is that margin shock. When the CME hikes requirements by roughly a third, every leveraged trader has to do math instantly. Either you wire more cash, you reduce position size, or your broker reduces it for you. That selling hits the market regardless of price. It doesn't matter if silver is at $80 or $100 or $60. When the margin call comes, you have to act. And here's the thing, that action creates selling pressure that's completely disconnected from fundamentals. It's mechanical, it's forced. It's not someone looking at the chart and saying, you know what, I think silver's going lower. It's someone saying, I literally have no choice but to sell right now because I don't have the capital to maintain this position. Then comes the secondary confirmation. Price starts falling into illiquid windows as Asia opens. You've got stops getting hit. You've got volatility spiking. And then options hedging kicks in. Market makers who sold call options suddenly have to sell futures to stay delta neutral as price drops. That selling validates the risk models, which triggers more forced selling. It's a feedback loop. Each wave of selling confirms that the risk was real, which justifies the margin hike, which causes more selling, which confirms the risk again. Round and round it goes. Here's what's wild about this. Even traders who were right fundamentally, people who understood silver's supply-demand story, People who believed in the long-term thesis, they still got flushed if they were over-levered. And when global markets reopen after a weekend, everyone has to react at once. There's no staggered adjustment. There's no time zone buffer. It's all pressure, all at the same time. Asian markets open first, liquidity is thin, and the selling starts cascading before most of the Western world is even awake. But here's the part that should make you nervous. Once forced liquidation starts, it doesn't stop just because price looks cheap. It doesn't stop because fundamentals are still intact. It stops when sellers are exhausted. It stops when volatility cools down. It stops when the US session can absorb the flow into the close. That's why early bounces after these kinds of moves are so dangerous. You get this relief rally, people think the bottom's in, they rush back in, and then another wave of forced selling hits and takes price lower again. The bottom isn't a moment, it's a process. And that process doesn't finish until all the weak hands are out, all the over-levered positions are closed, and the market can actually find equilibrium. Now let me show you what very few people are talking about. The timing of this margin hike wasn't random. It happened over the weekend. Markets were closed. Traders couldn't react. They couldn't adjust. They just woke up Monday morning to a completely different set of rules. And in that gap between Friday's close and Monday's open, price had already moved violently lower in overnight trading. So by the time most people could even log in, they were already underwater, already facing margin calls, already behind the curve. That's not an accident. That's how these things work. The exchange protects itself first. Traders have to fend for themselves. This is also why people are drawing parallels to the past, and honestly, they're not wrong to do that. This is the exact same playbook we saw in 2011 after silver's blow-off top. Let me paint the picture for you. In April 2011, silver went parabolic. It hit nearly $50 an ounce in a matter of weeks. Massive leverage, massive speculation, everyone piling in. And then what happened? The CME raised margin requirements. Not once, not twice, 5 times in 8 days. Each hike forced more selling. Each sell-off triggered more hikes. And the result was a brutal grinding collapse that took silver from nearly $50 all the way down to the mid-20s over the next few months. What happened next? It wasn't a clean bounce, it was choppy. It was emotionally brutal. There were rallies that looked like the bottom was in, and then more selling. It took months for the market to actually stabilize and find a real base. Same exact pattern we're seeing today. Blow off top, margin hike, forced selling, choppy bottoming process. The script doesn't change, the details do, but the structure is identical. You saw a similar rhythm in March 2020 across multiple markets. Not just silver, but everything. Stocks, commodities, credit, initial crash, panic selling, then a sharp bounce that felt like relief. People thought the worst was over. And then another leg down, as forced selling finished its job. The first bounce is almost never the bottom in these situations. Why? Because the first bounce is driven by hope and short covering, not by actual stabilization. The real bottom doesn't form until the forced selling is done, until volatility compresses, until the market can actually digest what just happened. When you zoom out, the pattern is consistent. Post-crash Mondays are not about clarity. They're about digestion. Volatility stays elevated. Price retests happen. And the larger story is that bottoms are processes, not moments. Especially after mechanical shocks like margin hikes. You don't get a clean V-bottom. You get a messy, choppy, frustrating grind that tests everyone's patience and conviction. Even if we look at other commodities, you see the same thing. Oil in 2014, 2015, blow-off moves, forced liquidation, choppy base building, copper in 2015, 2016. Same story. The mechanics are universal. When leverage gets flushed out of a market, it doesn't happen cleanly. It happens violently, and then it takes time for the market to heal. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. You've probably heard the word engineered floating around. People are pointing to the timing of the CME margin hike. They're talking about rumors around JP Morgan positioning. They're mentioning temporary disruptions at the London Metal Exchange and HSBC. Some people are connecting dots that suggest this was orchestrated, that big players knew what was coming and positioned accordingly. Could there be politics and power dynamics in how markets function? Of course. Could there be coordination behind the scenes? Yes. Could this be part of some grand conspiracy to suppress silver prices and protect legacy financial interests? Maybe. But here's the thing, you don't need a grand conspiracy to explain this move. Margin mechanics alone are enough. When you have a parabolic move in any asset, when volatility spikes, when risk models start flashing red, margin hikes are the predictable response. It's not some shadowy cabal pulling strings. It's risk management doing what risk management does. The exchange protects itself. Brokers protect themselves. And traders who are over-levered get caught in the crossfire. That's not conspiracy. That's market structure. Now, does that mean powerful players don't take advantage of these situations? No, they absolutely do. Big money knows how margin works. They know when hikes are likely. They can position accordingly. But focusing too much on villains can distract you from what actually helps you trade better. You can spend all your time being angry about manipulation, or you can spend your time learning the mechanics so you don't get caught on the wrong side next time. Which one helps you more? Here's what I want you to focus on. Focus on what you can control. Leverage, liquidity, confirmation. If you're trading with massive leverage, you're vulnerable to exactly this kind of move. If you're in illiquid markets, you're vulnerable to gap moves and forced selling. If you're not waiting for confirmation, you're catching falling knives. Those are the things that determine whether you survive these events or get wiped out. Not whether JP Morgan is long or short, not whether the CME is working with big banks. Those debates are interesting, but they don't change your risk management. There are probably three types of people watching this right now. The first type is overexposed and stressed. You're long silver, maybe leveraged, maybe in futures, maybe in mining stocks, and this move caught you completely off guard. You're down 30, 40, maybe 50% in a week. You're wondering if you should hold, if you should sell, if you should double down. If that's you, listen carefully. The priority right now isn't being right. It's surviving. Reduce risk, protect capital. Don't let one trade define your month or your year. I know it's hard. I know you believe in the thesis. But if you're overexposed, if you're losing sleep, if you're checking prices every 5 minutes, you're in too deep. Scale back. Live to trade another day. There will be other opportunities, but only if you still have capital to deploy. The second type is sidelined but excited. You've been watching silver, maybe you missed the run-up, and now you're thinking, this is the opportunity. This is the dip I've been waiting for. And maybe it is. But patience matters. Let the market prove stability before you step in. Don't try to catch the exact bottom. Don't be the hero who buys the first bounce and then watches it roll over again. Wait for confirmation. Wait for volatility to compress. Wait for a base to form. The best entries come after the chaos settles, not in the middle of it. You don't get extra points for being early if early means getting stopped out 3 times before the real move happens. The third type is long-term bullish but disciplined. You believe in silver structurally. You understand the supply deficit, the industrial demand, the monetary dynamics, but you also respect tape. You know that even if you're right long-term, short-term pain is real. For you, this is about scaling, not swinging. This is about building a position over time, not going all in at once. You're probably looking at this move and thinking, okay, if we get stabilization here, I'll add a little. If we wash out lower, I'll add more. That's the right mentality. You're not trying to time the exact bottom. You're trying to build a position at good levels with manageable risk. The universal rule for all three? Confirmation beats conviction in moments like this. You can have all the conviction in the world, but if the market's not confirming your thesis, you're just fighting tape. Wait for the market to show you it's ready to turn. Wait for the selling to exhaust. Wait for volatility to settle. Then act. So here's what I want you to answer in the comments. Which type are you? Are you overexposed and trying to navigate this? Are you sidelined and waiting? Are you scaling in over time? Let me know, because understanding where you are emotionally and financially is the first step to making better decisions. So here's where I stand. I'm not chasing bounces, and I'm not calling a bottom just because price feels low. I'm watching 3 things very closely. First, I'm watching whether $80 to $82 holds as real support, not just a bounce zone. If we're getting repeated tests of that level and it's holding with declining volume, that's a sign that sellers are getting exhausted and buyers are starting to step in. But if we're bouncing off 82 and then immediately selling off again, that tells me it's just a temporary pause, not a real base. Support isn't a price level, it's a price level plus behavior. You need to see how the market acts at that level to know if it's real. Second, I'm watching whether a deeper washout into $70 to $75 happens with declining volume. That would signal seller exhaustion. When you get these forced liquidation events, sometimes the final flush is the cleanest part. You get one more panic wave, volume spikes, and then it's over. Everyone who was going to sell has sold. The weak hands are out. And that's when smart money starts building positions. Now, I'm not saying we're definitely going there, but if we do, I want to see it happen on declining volume, not accelerating volume. Declining volume means the selling pressure is running out of steam. Accelerating volume means there's more pain to come. Third, and most important, I'm monitoring whether volatility and selling pressure ease into the US close. This move was structural and mechanical, not emotional. The fundamentals didn't vanish in a week. Silver's supply deficit is still real. Industrial demand is still growing. Central banks are still buying gold and silver. Monetary policy is still uncertain. None of that changed. What changed was the leverage structure in the futures market. And when leverage gets flushed, it creates opportunity for those who weren't overextended. But you have to wait for the dust to settle. Based on my analysis, this event was structural and technical, not fundamental. The fundamental picture for silver hasn't changed. You've still got a supply deficit that's been building for years. You've still got solar, electric vehicles, and electronics driving industrial demand higher. You've still got monetary uncertainty creating demand for hard assets. You've still got geopolitical tensions supporting safe haven flows. Those factors are all still in play. What happened here was a reset in the leveraged speculative positioning. That's painful in the short term, but it doesn't invalidate the long-term case. If history rhymes and silver stabilizes around these levels, the move that follows could be significant once confidence returns and new buyers step in. But that's a big if. We need to see actual stabilization first. We need to see the forced selling finish. We need to see volatility compress. We need to see a base form. Until then, everything is just noise. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the CME notices. Look at the historical precedents. Study the mechanics of margin and forced liquidation. Don't just take my word for it. Think critically. Make your own decisions based on your own risk tolerance, your own capital, your own timeline. If you made it this far, you're the kind of person who actually wants to understand how markets work, not just get quick answers. That mentality will serve you well. The people who survive and thrive in markets aren't the ones who have the best tips or the hottest takes. They're the ones who understand mechanics, who manage risk, who stay disciplined when everyone else is panicking or euphoric. You're building that skill set right now just by watching this and thinking through these concepts. If you found this valuable, share it with someone who needs to see it. Someone who's confused about what just happened. Someone who's stressed about their position. Someone who wants to learn how to read these situations better next time. Hit that subscribe button if you want more analysis like this where I break down market mechanics and show you how to think, not just what to think. And drop a comment below with your thoughts, your questions, your own observations about this move. I read every single one, and your input helps shape what I cover next. Stay sharp out there, think critically, verify the data, and make your own decisions. I'll see you in the next one.